Hello guys, today I'm here with an educational video for you guys, and this video I will tell you how interest rates and bond yields affect the stock market. So recently we've seen a surge in the US Treasury yield. So what is a US Treasury yield? I'll explain it to you guys. So the US government, the government of the USA uh, borrows money in the form of bonds. Okay, the government borrows money in the form of bonds. It issues bonds which the US population buys. And the working of bonds is a bond is considered a risk-free investment. Okay, risk free. So basically, there is no risk in investing for a bond theoretically. The only way your bond will fail to pay you back is when the government fails, which is a very low possibility. So the risk it is a risk free investment. The government bonds especially are considered risk free investments. So the public lends money to the government in the form of bonds. So the government issues bonds which the public can buy. So that money goes to the government and they repay an interest rate on these bonds. So it is so that repayments are called as coupon payments or coupons in short. So you can those repayments are coupons. So this coupons payments are made as a percentage. So for example, if a bond is worth, let's say, 100 rupees with uh, an interest payment of 5%, this means that every year the 5% of 100 rupees, which is 5 rupees, would be paid on yearly basis at and the bond, let's say, is a 10-year bond. The duration of the bond is 10 years. So for these 10 years, at the end of every year, you are paid 5 rupees, 5 rupees, and so on for 10 years. On the 10th year, you get your 5 rupees again plus your principal of 100 rupees. So this is how a 5% coupon bond works. Now this was the working of bonds, and uh, how do these bonds affect the stock market and the prices in the stock market? So when the government lends money, uh, when the government wants economic growth, it decreases the interest rates, which means the interest rates go down when the government this in, as the interest rates decrease on loans, more people would be willing to take these loans. So the number of people taking the loans would increase. So this would be number of people taking loans. This increases as the interest rates drop. Obviously, right? Because if the interest rate in two cases, let's say 5% is one interest rate and the 10% is the other interest rate. So there would be more people taking loans when the interest rate is 5% because you'll have to pay back lesser interest on it. So as the number of people taking loans increases, this leads to a rise in economic growth. Economic growth increases. So during the COVID-19 pandemic, when the economic activity stopped, the US government decreased the interest rates to encourage people to take more loans and to encourage economic growth. So that was back in March, April, May, in 2020, when the government wanted the economy not to halt and to grow. And now slowly, as there is growth seen in the economy and as things get back to normal, they are bringing back the interest rates. The interest rates go up. So Now, what effect does this have on the stock market? Now, there is a concept of valuation of stocks. Valuation of stocks. Now, this valuation is based on how much do you value a stock and how much return do you expect on it. Okay, so now let's go back here. Expected return of investors in the stock market. Now, the expected return consists of two returns: your risk free return, I'll put it as RF, which is risk free, plus an equity risk premium, ERP. Now, this risk free return, you generally take it as a 10-year bond yield, 10-year government bond yield, because that is the closest instrument we have which is risk free. And we consider the government virtually free from default. So, this would be the risk free return, the 10-year government bond yield, plus the equity risk premium. Because as you know, equity is more riskier than bonds. So you this risk premium you get on top of the government bond yield. So that would be equal to your expected return for investors. So now, as we've discussed, this risk-free return was being increased by the government, right? The interest rate was increased, which means the risk-free return increases is being increased by the government. This means as this risk-free return is increasing, your expected return for investors is also going up. Now, as the expected return for investors goes up, what does that mean? So, suppose you value a stock and you think that the stock would reach a stock is currently at 500 and you think it would reach 1000 rupees. So that is an expected return of 100%. Now, because of this increase in risk-free return, that 100% expected return might become 150% expected return. But you value it at 1000 only. It is still the stock will reach 1000 only because the underlying value of the company is the same. Now the current price, let's say, is at 500. So you are getting 100% return on your investment, but expected return is let's say I'm taking an example, let's say it's 150%, but you need 150% return. So this means that this final value is 1000 itself, but this 500, if this goes back to let's say 400 or 300, if this decreases, if the current price decreases, then your return would go up eventually. So that is why a risk-free return increase leads to an expected return increase in the expected return for investors, which leads to price fall in the current market prices. So that is the reason for the bond price, uh, the, the US market falling, and as a result of that, Indian markets also fell along with those. Now, coming to India, in India, the 10-year government bond yield was down to 5.6%, but but 5.6% back in March, but now it has increased to 6.18%. So even here, the interest rate has been increasing, which is a negative for the stock market. And a rally in the stock market, when the stock market is rallying up, it also tends to increase bond yields as less and less people are comfortable in being invested in the stock market. They move from stock market to the bond market, and they remove money from the stock market and start investing in the bond market, which increases the bond prices and decreases the stock prices. So that is how they are negatively related to each other. And there is much more to it than I've explained it in the simplest of terms, but there is much more to it, like the inflation rates and the interest rates of and the treasury yields and the repo rate at which the banks borrow from each. All these all these factor into the stock market, but this was the effect of the bond market on the stock market as a whole. So if you want a video on how the inflation affects the stock market, please comment down below. Thank you.